The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, as financial markets evolve and investors seek stability amidst uncertainty, one investment option has quietly captured the attention of many in Singapore: money market funds. Now, with low risk, short-term investments offer a more attractive yield compared to traditional savings accounts and fixed deposits. MMFs are quickly becoming an essential part of diversified portfolios. In a landscape where inflation is a growing concern, how are these funds and redefining cash management, and how are investors weighing their options? What factors are driving the shift towards these seemingly unassuming yet strategically powerful vehicles? Well, to dive into the rising popularity of money market funds here in Singapore, joining me now is Navin Sregantan, who is a financial literacy specialist at DBS. Navin, welcome to the show.
Hi.
Thank you so much for joining us. Navin, here in Singapore, it looks like the total net assets of MMFs domiciled here have more than doubled from $5.9 billion in January 2024 to $11.1 billion in January 2025, according to data from investment application Morningstar Direct. What do you think are the primary factors driving this increased interest among investors?
Yeah, I think in recent years, we've seen more people shifting some of their savings, into money market funds, which, as you mentioned, essentially invest in highly liquid, short-term debt securities. They usually mature within a year, and in particular, 3 months or less. So I think in a lot of the money market funds, my T-bills and MES bills, deposits with banks. I think among the reasons why we've probably seen an increase in this over the years is that we've been seeing a bit more interest, maybe from educational standpoint as well. People understand that such products exist. Retail investors at least. More of them are familiar with the products. And we've also been living through a period where we had seen some elevated interest rates of late. While these rates, are starting to come down, it's still higher than it was, let's say, in 2020, 2021. So, basically, if central banks raise interest rates to, let's say, combat inflation, money market funds, have kind of been attractive because their yield tend to increase with short-term interest rates. This actually tends to offer investors, a better return than maybe holding cash than they might find in a traditional savings account. Which this is one of the traditional drivers for interest in money market funds, at least among retail investors. I think another thing we need to consider is diversification in a way. I think they actually pull investment products, similar to unit trust. So, it's quite easy to invest in a diversified portfolio of such short-term securities.
Okay, so with the current low interest rates on traditional savings accounts and fixed deposits, how do MMFs, position themselves as an attractive alternative for investors looking for better returns?
Yeah, I think, yields on money market funds offer slightly above what you get with traditional savings accounts, fixed deposits, that's unlikely to change anyway, whether interest rates do go up or down. But better returns aside, right, I think they are attractive in that you can buy and sell them. Buying and selling them is pretty straightforward, unlike fixed deposits, T-bills, even, say, Singapore savings bonds, that there are no set subscription or redemption dates that you have to adhere to without any form of penalty. You can just buy and sell them as and when you like. They may be beneficial for someone who's actually requiring liquidity at short notice, or maybe if you need a quick access to your funds, maybe due to something unexpected, or if you have changing circumstances. That said, I think it's still important to remember that even though they're considered relatively low-risk investments, there's still some reinvestment risk, particularly in an environment where rates may be falling.
Well, given that MMFs generally offer yields between, 2.5% and 4%, how would you evaluate whether this return is compelling for conservative investors, particularly when inflation is a consideration?
Yeah, I think, the rates, again, they tend to, at the end of the day, with money market funds, they tend to be viewed as something safe, accessible, pocket money. It might not always beat inflation, but in the long run, I think why people actually look at it, they do have a better return than, let's say, a fixed deposit. I think it's also important to remember that when it comes to investing or even just saving for your long-term future, you should probably just not just stick to using, fixed deposits or money market funds as a way to grow your money over the long run. Granted, they offer a sense of security, but compared to, let's say, buying stocks, it's still important to think of beating inflation over the long run by purchasing, making other investments.
Well, MMFs are typically considered low-risk investments. So how do you assess the risk-reward profile of MMFs compared to, more volatile investments like stocks and bonds?
Yeah, I think it's a little bit like what I mentioned before, right? Even though they are being low risk, you can't be too over-reliant on them. because it can present some challenges. But that said, it's okay to maybe portion some of your money or a good amount of your money, depending on your risk tolerance, or into such products. But at the end of the day, if a portfolio is, heavily weighted in short-term investments, it's not going to generate sufficient long-term return to outpace inflation. So I think I'll just use a case in point here. If you're a young investor, it might be good to actually have a check, to have an understanding of where your risk tolerance is. Because, if you're a young investor with a long time horizon, right, you actually may miss out on higher growth opportunities in the long run.
Okay.
I think bear in mind that we are living a fair bit longer, and we probably need a lot more retirement funds than, let's say, previous generation. So that's something that you should always consider.
Okay.
Well, yeah.
Well, then how do you advise investors on incorporating MMFs into their broader investment portfolios, especially when balancing, the higher risk assets like equities?
Yeah, I think it's not just money market funds that we're looking at. I mean, when it comes to investment portfolio, while a lot of people may be looking most identify with investing in equities, you still have bonds and longer term bonds that you can consider incorporating into your portfolio. Okay. So I think the way I'll see it is that, you can always store a small amount of your portfolio in money market funds, if you have no needs for the money or you're looking for good opportunities to enter the market.
Okay.
But it shouldn't dominate the portfolio,
right.
And especially for people who are still quite young. I guess as you get older, you might portion more of your money into bonds, fixed income investments, and money market funds. But if you're younger, it is probably not a good idea to have too much of your savings in there. Yeah.
Well, then how do MMFs compare with, CPF or mutual funds, and how should investors decide which investments are better for them?
Yeah, I think we need to realize that, CPF is actually, designed for retirement, housing, healthcare, while, most money market funds may be better suited to short-term goals or as a place to temporarily hold cash. So in other words, if you have to invest, if you have a short-term horizon, you might want to invest more in money market funds. Or if you have to preserve what wealth you have because you're retiring and you want something safe, that might be something that you can do. I think when we look at CPF, we should always think about how it has been designed from day one to serve the long-term needs, like retirement. And one option that some people do out there is they do top up their CPF funds, right? Maybe they do cash top-ups. But we have to remember that these CPF top-ups are not irreversible. But with maybe money market funds, if you have temporary needs, or if you're not sure whether you have unforeseen needs for some of this money, you can't exactly withdraw money from CPF before a certain age. The money market funds is quite liquid. You can still withdraw them anytime you need. I think if you're highly risk averse, right, like the guaranteed returns that CPF gives you, she might be preferable. So it's guaranteed, it's backed. It's just that you have to wait a fair amount of time before you can withdraw them.
So is it safe to say that MMFs shouldn't be used as a long-term investment? I mean, they can't be used for long-term retirement planning and they're better suited for short-term cash management? Not
necessarily. I think it really depends. Some people are risk averse, and if they're really risk averse, it's always better to invest in things that are related to your ability to handle risk. In that way, for some people, and some people really like investing in riskier assets, and they don't lose sleep when markets do go up and down. But for some people, small movements actually cause them to lose some sleep. So it might work for them based on risk tolerance. I think it's important to remember that money market funds are useful in a very diversified investment portfolio as well. It's just that you might not. The key point, of course, is that you shouldn't be putting the bulk of your funds in it, unless, of course, you're already retired and you want a safe capital preservation investments, and then that might be more useful.
Okay. Well, overall then, how do global economic factors such as trade uncertainties or geopolitical risks influence the demand for MMFs in markets like Singapore?
I think one of the concerns out there people have, of course, is, this is the idea that, or this feeling that, interest rates will continue to decline, right? So I think for investment like MMF, I think it's important to remember that they, like your fixed deposits, the interest rates that you get on there will actually decline if, the interest rates will, as the interest rates decline, the yields that they offer will also decrease, partially because of the short-term nature of the instrument. Some of the concerns I think people have, might be a bit, in a low interest rate environment, investors may actually want to seek alternative investment vehicles that offer potentially higher return, even if it means like taking on more risk. This is something that could happen in an environment where interest rates are down because, you're chasing yield. And I think declining money market fund yields might actually cause, like say, investors to shift to something that might be riskier. So it's not surprising to see them maybe invest more in equities, or they might simply just want to, if they're really very risk averse, they might just hold on to cash, accepting like a lower return.
Well, on that note, with the possibility of, interest rates continuing to decline here, what impact do you foresee on the performance and returns of MMFs over the next few years?
Yeah, I think it's really hard to predict because, you're not really sure of the future right now and where, returns, what the interest rate environment will be like. Of course, we're expecting it to go down, or a lot of people have the view that, we might see it, drop a little bit. So likewise, the performance of the returns of the yields you get tend to track the interest rate. So if we are in a lower interest rate environment, you will probably see, like interest returns on like a fixed deposits and, even yields on market funds actually decreasing. So
I see. Well, thank you so much, Navin, for your time and your insights today.
Thank you very much.
Thank you. That was Navin Sregantan, who is the financial literacy specialist at DBS. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.